What if some of the most famous football clubs in the world are actually examples of how people invest in the wrong assets? A club can generate nearly €1 billion in revenue, sell out stadiums every week, and still struggle with debt and financial pressure. On the outside, everything looks powerful. On the inside, the structure tells a very different story. So here's the real question. Why do some of the biggest football institutions in the world look rich but behave like fragile financial systems? Because in football, high revenue does not always mean high profit. And popularity does not always mean stability. In this video, we will break down what football clubs secretly teach us about bad investing decisions and how you can avoid the same mistakes in real life. Let's get started. 1. The illusion of wealth in football clubs. Football clubs look like perfect businesses from the outside. Huge fan bases, global brand value, massive sponsorship deals, and constant media attention create the impression of unstoppable financial strength. But when you look deeper, the reality becomes very different. Many top clubs operate with extremely thin margins, heavy debt structures, and rising internal costs that consume most of their income. This creates a dangerous illusion. Revenue looks strong, but actual financial health remains weak. Fans see success on the pitch, but investors see pressure behind the scenes. This is where the first lesson begins. In investing, what looks powerful on the surface can still be financially unstable underneath. 2. Revenue versus real profit misunderstanding. One of the biggest mistakes in investing is confusing revenue with real profit. Football clubs often generate massive income streams from broadcasting rights, ticket sales, and sponsorship deals. On paper, the numbers look impressive. But after subtracting wages, operational costs, transfer fees, and debt servicing, the remaining profit becomes surprisingly small or even negative in some seasons. Some elite clubs have reported revenue close to €1 billion, yet still struggle with financial imbalance due to poor cost structure management. The lesson is simple but powerful. Top-line growth means nothing if bottom-line stability is weak. In investing, profit is what matters, not just movement of money. 3. Wage inflation and fixed cost pressure. Football clubs clearly expose one of the most dangerous risks in investing: rising fixed cost pressure. As clubs grow bigger and more successful, salaries for players increase at an even faster rate. In many elite teams, wages alone consume around 60 to 70% of total revenue, leaving very limited financial flexibility. At first, this looks manageable during winning seasons when income is strong. However, the real problem appears when performance drops or revenue slows down. Even in difficult periods, salary commitments remain locked. Contracts cannot be easily reduced, which creates a rigid financial structure that keeps draining resources regardless of results. This situation closely mirrors businesses with high operating leverage, where costs stay fixed but income becomes unstable. When revenue falls, expenses do not adjust at the same speed, which creates immediate pressure on cash flow and long-term sustainability. The lesson here is clear. Businesses with heavy fixed costs can become dangerous during downturns because they lose flexibility. 4. Star dependency and concentration risk. Another major mistake football clubs repeatedly make is over-relying on a single star player to carry the entire system. A world-class player can completely transform a club's identity. He can boost merchandise sales, increase ticket demand, improve match performance, and attract global attention within a short period of time. However, this also creates a dangerous concentration risk that is often ignored during successful periods. When too much value is tied to one individual, the entire structure becomes fragile. If that player gets injured, loses form, or transfers to another club, the impact is immediate and severe. Revenue can drop, performance can collapse, and fan engagement can decline almost overnight. This pattern is not limited to football. It mirrors a common mistake in investing where people depend heavily on a single stock, one product line, or one income source. At first, it may look efficient and highly profitable, but in reality, it increases vulnerability. Football clearly demonstrates that relying too much on one asset creates long-term instability. Diversification is not just a smart choice in this context. It is a survival strategy that protects systems from sudden shocks and unexpected failures. 5. Emotional valuation versus real value. Football clubs are also heavily influenced by emotion and branding. Many investors and owners buy clubs not purely for profit, but for prestige, identity, or influence. This often leads to overvaluation decisions that are disconnected from real cash flow performance. The emotional value of a club can be extremely high, but emotional value does not always equal financial value. In investing, this is a critical trap. When decisions are driven by admiration instead of analysis, overpaying becomes very likely. Football teaches us that emotional attachment can distort financial judgment very easily. 6. Sunk cost behavior in transfers and decisions. Another important lesson comes from transfer decisions and management behavior. Football clubs often continue investing heavily in underperforming players or managers because they already spent large amounts on them. Instead of cutting losses early, they double down, hoping for recovery. This increases financial pressure instead of reducing it. This is a classic sunk cost mistake. In investing, continuing to fund a failing decision only because you already invested in it leads to deeper losses. The smarter approach is always to evaluate future value, not past spending. 7. Structural industry pressure in football. Football is also a unique industry because it forces continuous spending just to remain competitive. Even successful clubs must reinvest heavily every season in transfers, wages, and infrastructure upgrades. Without constant investment, performance drops quickly. This creates a cycle where even strong revenue does not guarantee long-term financial growth. In investing terms, this is a capital-intensive environment with low efficiency. Businesses that require constant reinvestment just to maintain position are often harder to scale and sustain. 8. Why football clubs look rich but behave fragile. When all these factors come together, a clear financial pattern starts to appear. Football clubs often look extremely wealthy from the outside because of their global branding, massive stadiums, media attention, and worldwide fan base. This creates a strong illusion of financial power and stability. However, inside the system, many of these clubs operate under fragile financial conditions. High wage structures, emotional decision-making, and dependency on key assets create constant pressure on long-term sustainability. This creates a sharp gap between appearance and reality. Many investors and fans confuse visibility with true financial strength, but in reality, stability depends on cash flow discipline, cost control, and structural balance rather than popularity or fame. Football ultimately becomes a powerful mirror of investing mistakes, showing how easily financial health can be misjudged when people focus only on surface-level success instead of underlying economic structure and risk management. 9. Real investing lesson from football. The biggest lesson football teaches is simple but powerful. Good revenue does not guarantee good investing. A strong brand does not guarantee strong profit. And popularity does not guarantee financial safety. True investing success comes from low fixed costs, diversified income, disciplined decision-making, and avoiding emotional valuation traps. Football clubs show what happens when these principles are ignored at scale. 10. How you can avoid these mistakes. These lessons are not limited to football or large corporations. They apply directly to personal finance and investing decisions. If income increases, avoid increasing fixed expenses too quickly. If a business or asset looks popular, still check the real profit structure. Do not rely on a single income source or investment. Always separate emotional preference from financial logic. Most importantly, focus on cash flow stability instead of surface-level success. This is how you avoid investing in beautiful but weak assets in your own financial life. At the end, football clubs are not just sports organizations. They are live financial systems that reveal how money behaves under pressure. They show that high revenue can still lead to weak financial outcomes if structure is not strong. They show that emotional decisions can destroy financial logic. And they show that real wealth is not about visibility but stability. In the end, investing is not about how impressive something looks. It is about how strong it remains when conditions change. That is the real lesson football teaches about money. If you understand this, you will never look at football clubs or investments the same way again. Always focus on profit, structure, and long-term stability instead of hype and emotion. Real wealth is built by avoiding weak systems, not chasing flashy ones. If this video helped you understand money differently, like, share, and subscribe for more deep financial breakdowns like this.